Here he is. Hi, Dominic.
Hi.
I can hear you. You and me so far, huh? Nobody else. I heard the Dodgers won last night. Is that correct?
Yeah, it is.
Do you have any? I don't know if you're that interested. Do you have any thoughts on that pitching change the Tampa Bay manager made?
Yeah, well, I'm happy he made it because Snell was mowing down the Dodgers hitters, and after that, it seemed like they got some life.
I mean, I was shocked.
Yeah,
I
me too.
when he came out to the mound, I thought he was just going to go out there and give the guy a breather,
Yeah.
and next, oh my God, it's just unspeakable. But
Hmm.
that's baseball in 2020. No more complete
Yeah.
games. Nobody pitches deep into games anymore,
Hmm.
But the
Are
Dodgers took
you a
advantage.
Yankees fan?
Me, I'm a Met fan, actually.
Mets
Cleveland
fan, huh?
Indian. My New York Mets are pretty sad, right?
Well, they made the World Series in 2015, so
Yep.
feels like a lifetime ago, but
Yes, yes. I was in your position. I was probably around your age when they won the World Series in 1969. That was an unforgettable
oh
year.
yeah. Hmm.
Beat the Orioles. Hey, Dominic, I have a feeling it may be just us here, okay?
All righty.
So why don't we get going? What time is it? It's 10:01. All right. I'm gonna make sure I can share the screen, not have the trouble we had yesterday. We had all kinds of trouble sharing the screen. All right, here we go. Can you see the PowerPoint, sir?
I can.
Man, we are off to a good start, huh? Okay. All right. The first thing I want to tell you and everybody else, if they look at the video, there's a pretty good test review video on my YouTube channel, and Cornelia put it into Canvas for you guys. It's a review I did last semester with my 230 class. It covers chapters 6, 7, 8, which is the test material coming up, okay?
Mhm.
So just to give you a heads up on that. Okay, here we go. Chapter 8, we're running through this balance sheet, huh? Chapter 6, we went through cash and accounts receivable. Last chapter 7 was about inventory. Here, fixed assets. Fixed assets. These are the big ticket items. And let me welcome Suda. Hi, Suda.
Good morning, Bob.
Good morning. Say good morning to Dominic.
Hi,
Good morning.
Dominic.
It's just the three of us again, okay? I was
Okay,
just
no worries.
got to tell your friends to join us. I was just saying, Suda, that I put up in Canvas now a very good, I think, test review for chapter 6,
Okay,
7, 8. I did last semester. Cornelia, I asked her to put it up, so that might be helpful when we get done. Okay, we're
cool.
just
Thank you.
beginning. Yeah, fixed assets, huh? Fixed assets, long-lived assets, huh? Long-lived assets, you're going to use them in the operation and get benefits out of them, huh? You're going to have a machine that stamps out cans or something, and that machine might last you a long, long time. We're going to be talking in this chapter about tangible assets and then intangible. Tangible meaning you can touch them, they have substance, they are there to be held and moved. Intangible, we're going to be talking about long-term assets like copyrights, trademarks, patents, goodwill. So let's keep going here. Long-lived assets. You got land, assets subject to depreciation, buildings and equipment, furniture and fixtures. It can be a lot of things, natural resources. And then you have natural resources which you deplete, and you have intangible items which you amortize. So to really confuse things at the beginning, I'm going to tell you that you depreciate physical equipment, you deplete natural resources like an oil well or a coal mine, and you amortize intangibles. And that's kind of where we'll be going here. And they're just showing you Southwest's balance sheet and the types of things they have for fixed assets, flight equipment, ground property, etc. And here we go. Let's talk a bit about acquisition cost. When you buy a fixed asset, you are going to debit machines, say you buy a big machine of some kind, the size of a truck, and you buy this machine and it costs you $1 million. That's the purchase price. But you might have to pay sales taxes on it. You might have to pay for a special truck or something to bring that into your factory. There may be some legal fees. And this item we just bought is so big, we have to knock a wall down in our factory or our store to get it in. Installation costs. Every one of those will be added to the cost of the purchase price. And that total is what we're going to debit, okay? We are going to capitalize all these things. When we use the word capitalize, we mean we're recording something as an asset first, okay? So let's see what we have here. Measuring acquisition costs. We just talked about equipment, buildings. You buy a building, you probably are going to renovate it, and you're going to probably have to pay for title fees and registration with the county and city. Land, same thing. One point on land, you do not depreciate land. You don't do it. You don't. Here we go. Southwest Airlines bought some planes from, I guess, Boeing or somebody, huh? And they paid $75 million in cash. Oh, forgive me, I skipped ahead, huh? They paid 74 million in cash, 1 million in cash, and the balance they borrowed, okay? So journal entry's not too tough there. You debit flight equipment. Oh, for heaven's sake, this thing is, you notice they're not showing us the journal entry for the 1 million and the note. Okay. Purchased aircraft for 75 million cash. Okay. We should see here a debit to cash for 75 million and a credit, a debit to flight equipment, credit to cash for 75 million. And that's what they're apparently showing us on the next page. Let's see if they give us the other one with the note. Oh, thank goodness. Okay. They bought some more flight equipment, probably a plane, huh? That's probably just one plane, 75 million. And this time they paid a little tiny down payment. Oh, there it is. I'm sorry. Now we finally get to it, huh? And you can see pretty easy, huh? We bought a $75 million plane. We put $1 million in cash and we're able to borrow the rest. We went to a bank or we went to a hedge fund or something. We borrowed that $74 million. Let's see what else we got. You can also buy something without cash, huh? Oh, hi, Nicole. How you doing?
Good morning.
Okay, we acquire a plane for non-cash. You might be able to give out stock or something. So here, Southwest gave Boeing 1 million shares of their stock, plus 25 million in cash. Southwest said to Boeing, look, I can't give you 75 million now, but I can give you 1/3 of it, and I'll give you 1 million shares of our stock. And they accepted the deal. And here's what we're going to be looking at. Take a look at the journal entry. The journal entry. We debit flight equipment for the full 75 million again. We gave them 25 million in cash. It was 1 million shares at $1 a share. So we know that's going to be the common stock line, the difference, additional paid in capital. And that 75 million there, That's called capitalizing, putting it on the balance sheet. You can also build your own equipment, and that gets all capitalized. For example, the place I worked for in downtown LA on October 1st, 1987 was kind of demolished in the Whittier Narrows earthquake. And we had to find out if we are going to stay in business. And we ended up buying a building in Baldwin Park, California, and we pretty much had to redo the building. And that's what we're talking about here. You are going to, they don't give you any journal entries here, but an example is you build your own asset. You build your own machine. You're paying your own people, laborer. You're paying your laborers to do it. There's overhead involved, maybe interest during construction. That can all be capitalized. That can be a debit for the 75 million. Hi, Maria, how you doing? Welcome. Let's understand the difference between a repair and an improvement. A repair and an improvement. An improvement is an expenditure that makes the asset last longer, perhaps. It makes the asset more efficient, and it's something you don't do very often, okay? And it has to be typically a large amount of money. So we have this 10-year-old machine. It has a life, a depreciable life of 20. We just sunk another $1 million in it, and now that machine's going to last us another 25 years. All of those costs would be a debit to the fixed asset. Don't compare that. Let's compare that, I guess I should say, to an ordinary repairs and maintenance. You have a big machine, and you know from the manufacturer that you have to change the oil once a year. That is not increasing the life of the machine. That's just maintaining it. That is an expense. That would go into a category of repairs and repairs expense, or utilities expense, or something, oil expense. Anything that just is normal. You buy a big car, and you change the oil every year. That's an expense. You tune it up once a year. That's an expense. But you rebuild the engine, and you spend a lot of money. That would be in the neighborhood of an improvement. Just want to know that difference, huh? The word capitalize, it just means that it's a cost we're going to put on the balance sheet as an asset. And if it was a repair, it would just be an expense, huh? That little difference there is good to know. We talk a little bit about this class on accounting frauds in history. I remember talking about Enron with a few people. Look what WorldCom did. This was a very famous case about, here it is right here, 2001. Expenditures that should be recorded as expenses are improperly capitalized, you are really creating some fraud here. What this company did was, to make a long story short, they took all of their expenses, 3.8 billion, and they capitalized them. They put them on the balance sheet. Instead of calling it salaries expense, they called it improvement on an asset or something. Well, what that did was it made their profit look 3.8 billion higher than it really was. And they issued these phony financial statements to the world. And before they were caught, a lot of people lost a lot of money. Okay, now we're in the guts of the chapter, huh? We're in the guts here. Depreciation expense. We should know one of our adjusting journal entries is a debit to depreciation expense and a credit to accumulated depreciation. What we're going to learn here are a couple more methods other than straight line, okay? So you buy an asset, you put it on the balance sheet, and then over time, you're going to record the depreciation expense over the life of that asset. Understand the two terms clearly. Acquisition cost, that's what you bought and debited equipment. Depreciation expense means 1 year. And expense, when you're talking expense, you're only talking for one fiscal period. So that's your debit to depreciation expense. And here's your credit to accumulated depreciation, which we all know is a contra fixed asset account. Okay. So depreciation is all about taking this acquisition cost and expensing it over time. Depreciation is a method of allocation. It has nothing to do with the market value, nothing to do with it. It must be allocated on what they call a systematic and rational basis. And the remaining balance sheet amount, I'm going to say almost never has any relation to the market value. The undepreciated cost is not measured on a fair value. What they mean is we don't raise the price of an asset. So they're just giving us a quick look here of a journal entry. We know the journal entry, right? Debit depreciation expense, credit accumulated depreciation. Now, how do we depreciate an asset, huh? We need to know the acquisition cost. We need to know the useful life, which we assign, and the residual value, meaning the scrap value. And we're going to learn three methods here. We're going to do straight line again, just to get warmed up. And then we'll look at the units of production and the accelerated method. So here we go. Straight line. Now, this is what we learned earlier in the chapter, and it's certainly worth going over again here. At the beginning of the year, Southwest purchased something, some of those carts you see these guys loading up the plane. They paid $62,500, estimated useful life 3. They have a residual value of $2,500, scrap value. What that means is they think at the end of 3 years, somebody will give us $2,500 for these old beat up carts, or a junk dealer will come in and take it off our hands for $2,500. The key point with straight line is you do not depreciate the residual value. So you have to subtract it. 62.5 minus 2,500 is 60,000. Your depreciation expense will be $20,000 a year. And this is, I'm not sure how interesting this is, but they're showing you that Southwest assigns a life of their planes of 23 to 25, United 25, Singapore Airlines is only 15. Does that mean that Singapore is changing its fleet out every 15 years? I'm not sure that's what it's saying, but these things have to be a reasonable number. Okay, straight line, here we go. 62.5 minus 2,500. And look at our little grid here. Look at this grid. You're going to see this for all three methods. Okay. Up on top, you're going to put the book value. Up here, you will include the scrap value, the residual value. You're always going to start with that gross number, if you will. We are going to depreciate just the 60,000. So our journal entry, here's our journal entry. We're going to debit depreciation expense. We're going to credit accumulated depreciation, which brings the balance down, the net book value down to 42.5, and the balance after year one in the accumulated depreciation account, which is a contra asset, was 20,000. Look at the next 2 years. Again, the next 2 years, we're going to write the same exact journal entry. We're going to debit the expense, depreciation expense, credit accumulated depreciation. The accumulated depreciation balance goes up by 20,000. And at the end of 3 years, we have fully depreciated this asset, and we have a remaining residual value of 2,500. You never bring the book value below the residual value. So the important thing is in two of these three methods, we have to subtract the 2,500, but be smart enough to know we don't depreciate, in this case, more than $60,000. So anybody have a question on that? Not too bad, I don't think, right now. Huh? You've seen this before. Let's look at the units of production method. Units of production, okay? Here we're talking a vehicle. It could be a machine that's stamping something. We're going to take the cost and subtract the residual value, just like we did before. And here, they bought this equipment for $62,500, using the same numbers, I guess, huh, with the residual value. So they are estimating at the beginning that this equipment's going to travel 100,000 miles. 100,000 miles. What that's going to do is give us a rate of 60 cents a mile. Unit of production method. It could be miles, it could be gallons, it could be pounds, it could be stamps, a machine that hits a, welds something quickly. Depreciation calculation is the same in terms of the treatment of the residual value. 60,000 divided by 100 is 0.6. How many miles did they drive this car the first year? They will give you these numbers here. They're going to give you these numbers. All you have to do is multiply these numbers by 0.6. And that's what we did here. First year, 30,000 miles they actually drove, means 18,000. 6 times 3 is 18. There's our debit and there's our credit for that year. And here is the book value being reduced by 18,000. And they're just showing you the calculation again. 60 cents a mile. Not too tough. You do a couple of these and get the hang of it, I think. Here's the completed grid, the completed template. The next year, we really worked this equipment. We drove it 50,000 miles. 3 times 6 times 5, 30,000. Debit depreciation expense for 30. Credit accumulated depreciation for 30. And the accumulated depreciation balance is now 48. And the book value is 14,500. 20,000 times 6, 2 times 6, 12,000. We have now reduced the book value to the residual value, and we have fully depreciated this asset. Any questions on this method here? It's a new one. You're seeing it for the first time, but units of production. We're going to estimate what the usage is in some kind of unit of measure. It could be miles like this. Like I said, it could be a lot of different things, huh? Unit of production method. Let's have some fun with the third method. Accelerated depreciation. Here, companies can, if they wish, just like in Chapter 7, they could choose LIFO or FIFO. Here, they can choose one of these 3 methods and even other methods. Accelerated depreciation. You're going to put a lot of the depreciation in the first years, and the last few years are going to be lower, and lower. Okay, so here's what we are talking about. You see it says you see it says declining balance? Make a note to yourself, put the word double in front of declining balance. It's very important. I want you to think of that as double declining balance. Okay, so important. And the reason is this rate will always be double what straight line would have been. It would have been double what straight line. For example, if you have an asset for 5 years, straight line would be 1/5. Double declining balance would be 2/5 or 40%. And let's look at this and see if we can get you through here. Southwest purchased this equipment again. They keep buying this stuff over and over, okay? Same information, but now double declining balance. It's 3 years, right? 1/3 is 33% a year. We double that to 2/3. That's why I call it double depreciation. Net book value is 62.5. The life is 3 years, but we're not doing 1/3 a year evenly. We're doing 2/3 the first year. In other words, every year, we're going to multiply this by 66.6%. 2 times 1/3. 1/3. And here we go. So the first year's depreciation under straight line was 20,000. Look at this, it's 42,000 almost. And we immediately knock the net book value down to a much lower number. So let's see here. Let's look at our famous grid. Notice on this method, and I'm sure this is going to be mentioned on the test in one way or another. On this method, we ignore the residual value. We don't subtract it. We depreciate the full 62.5. That's one subtle difference with this method too, okay? So let's see here. We purchased this thing for 62.5, and it's a 3-year item, which would have been 1/3. Double declining balance makes it 2/3. 62,500 divided by 3 times 2 gives you that number. Okay. Notice the big expense the first year. Companies have the ability to select this method. Select this method. They'll save taxes in that first year if that's what they choose to do. And other little twist here, another little twist. Well, we know we're depreciating the whole 62.5 to begin, right? We're not subtracting that 2,500. So 62.5 times 2/3 is this. 20,833 times 2/3 is this number. And that leaves us after the second year with this here. Look what happened in the third year, though, and this is important. Our depreciation expense in the third year was 4629, but look what it did. It brought the residual value below 2,500. No can do. You can never bring the book value below the residual value. And that's true for all of the methods. So we are not going to be able to record the whole 4629. We're going to have to step on it with 4444 to end up with the 2,500. Anybody have anything to say? No?
How do you get to 444?
Here you go, Suda. When we did 2/3 in the third year, we ended up with 2,315. We cannot go below 2,500. So to answer your question, 6944 minus 2500 is the
Oh, okay. Okay, perfect. Thank you.
good question. Okay. Depreciation expense is limited to the amount that gets you down to the residual value. Depreciation, and they're just showing a graph with this here, most expense in the first year and then lower and lower. It's a strategic decision by management, huh? Here they're just pointing out in your 10K and your annual reports, there'll be a lot of notes about the fixed assets. They'll talk about their policy, any changes to it, how long they're depreciating, what method they use, the reasons why. I'm not going to worry about tax reporting. The reason we don't go into the tax reporting or the payroll in certain classes is there are 2 wonderful courses you can take. Uh-oh. We've now gone through the 3 depreciation methods. Now, measuring asset impairment. Impairment means that this asset is no longer worth what the book value says it is. It's similar to lower of cost or market in that if the cost of an inventory item goes below market value, or the market goes below the cost, we got to pick the lower. Same kind of thing here. We have an asset and maybe it got banged up. Somebody ran a forklift through it, or it's obsolete. It's making a product that nobody wants anymore. This machine right here, it might be a VCR machine or something. You know, nobody's going to buy those anymore. So the asset is impaired. It means we must recognize a loss at that point. And that's the only point they want to make there, I think, right now. We'll get back to that, I believe, in a few more screens. Guess what? You can also get rid of your assets by selling them. You have a machine that you're depreciating for 10 years, and in the middle of year 6, you decide you're going to get something else, and you can sell that old machine. Well, when you do that, you have to record the gain or loss on that sale, or sadly, an involuntary disposal, huh? Recognize the loss when the asset loses value. Here, I'm going to give you the Bob Smagula tip. Disposing of a fixed asset, okay? We dispose of a fixed asset. We have to debit cash. We have to debit cash if we're selling the asset and record the appropriate gain or loss. We have to get rid of the accumulated depreciation and the original item. I'm going to make this a lot easier than it sounds right now, but I'm just going to go through the screen here. If the cash is more than the net book value, you have a gain, obviously. If the cash is below the net book value, you got a loss or you break even. Southwest Airlines sold flight equipment for $5 million at the end of 17 years. So they depreciated this thing for 17 years. 17 times 5, 7, 5, whatever that number is. Had a useful life, no residual, huh? The amount of depreciation recorded at the end of the 17th year is how much? Useful life of 20, and they bought it for $20 million, 20 into that number. If there's a God in heaven, it's B. Okay? $20 million. We're depreciating it for 20 years. So we've depreciated we depreciated $17 million, right? After 17 years, the book value is $3,000. After updating it, I guess I just answered our own question there. What's the book value after 17 years? Be $3 million. Okay. We purchased it for 17 years, $1 million a year, $3 million. So we're getting rid of this asset. We're selling it. And we sold it for how much? I don't recall. We sold it $5 million, right? We sold it for $5 million. What was the net book value? All right. Who wants to tell me what we have here? What's the answer? Well, we got all day here, right? We sold an item with a net book value of 3, and we sold it for 5.
It was
2
like
million
gain.
gain.
Yeah.
Oh yeah, now everybody talks up the same.
Well, it's on mute.
I have to think it.
Maria's saying, "Hey, I was muted. I had that answer." Okay, so that's the thrust of what we're doing. Now let me make this as easy as I can with the journal entry. as easy as I can. We have to write this journal entry. See that journal entry? It is always the same. When you get a problem on disposing a fixed asset, selling a fixed asset, you are always going to have the same two debits and the same two credits. You're always going to have a debit to cash or stock or whatever they gave you. We'll assume cash. You're always going to have a debit to cash. You are always going to have a debit for the accumulated depreciation because we have to take that net book value off the financial statements. So we debit cash, that increases cash. We debit the contra, accumulated depreciation, which we know is 17 million. The original cost of the asset was 20 million. 20 minus 17 means we're getting rid of it, and there's our gain. So I kind of encourage you with the disposal of a fixed asset, it's always the same quadrant there. It's always going to be a debit to cash, credit to accumulated depreciation, a credit to the fixed asset's original cost, and a gain or a loss will ensue. They're putting the flight equipment on the bottom because at that point, you don't know if it's a gain or a loss, okay? One other tip. If you find yourself getting rattled and you've got this number right, and you got that number, and you got that number, take a deep breath. All you do is balance this. That's 22 minus 20, okay? So I think with that little item in the back of your mind, disposals of fixed assets, not too tough. Hey, how about that? We're done with the depreciation. Now we're talking depletion. Depletion, an oil well, you're using up oil. And if you don't mind, I'm going to deplete something right in front of you. I just depleted some. You don't know. You don't want to know what I put into this bottle. Anyway, I depleted some soda. We're using up a natural resource, okay? And if you understand the units of production method for a fixed asset, this is pretty much the same thing. So the total cost of the asset is not just the cost of the land and the mine. It'll be, it might be years and years and years of engineers digging for oil. And whammo, we finally, struck oil. Now we have an asset, okay? So it's a non-current asset, we know that. And we're going to deplete it, just like units of production. Just like units of production. And just like units of production, we're going to take the original cost, we're going to subtract the residual value, and divide that difference by the recoverable units. So let's see what we got here. Let's see what we got. We have a rate. Oh my goodness, this thing is even a little confusing to me. What are they talking about? Depreciation. We'll skip that. Oh my goodness. What we're talking about is this. Apparently, they're not going to demonstrate it, but very simply, we drilled for oil and we finally struck oil. Our engineers come to us and tell us that there is there are 1 million barrels of oil in this well. We're going to come up with, say, 1 million barrels of oil. That oil well cost us $10 million to find out we had the million. 10 million divided by the 1 million means it's $10 a barrel. And for those of you who came in a little bit late, I was talking with Dominic in the first minute or two. I asked Cornelia to put a review I did for chapters 6, 7, and 8 in the Canvas module. It was a test review from last semester, and I think it's pretty good, and hopefully it'll help you when we get done here. Okay, depletion. I wish they went into that a little more. Amortization. Amortization. Non-current. You can't see them. Sometimes the life is hard to understand. And what we're really talking about is intellectual property, goodwill, which we'll talk about, copyrights, trademarks, copyright. You write a book today and it's a big seller, you and you alone get the stream of revenue for that. No one else can publish that book as long as you have that copyright. A trademark, the McDonald's logo. You know, you can't open up a hamburger stand across the street and put up a logo that looks exactly like it, you know, and call it something similar to McDonald's. Patents, that's a big one. We'll talk about that. Acquisition of an intangible asset. Some rules here. Definite life. We have to know definitely how long this intellectual property belongs to us. Okay? And there are rules under GAAP. You don't have to memorize those. For example, patents, I think, are 20 years. Copyrights are the life of the author plus another 50 or something. And here we're just using straight line. So the important thing to begin with, we have to know the life. If we don't know the life, we don't have to do anything with it. We do not amortize it, okay? All we're going to do is look at it every year to make sure that it's still worth what we think it is. Amortization is similar to depreciation and depletion, more like depreciation, okay? Here is a new concept you're seeing for the first time. Have you ever heard of the word goodwill in regard to a financial statement before? Anybody? Goodwill. It is an intangible asset. Goodwill results when one company buys another company, and goodwill is only on an intangible asset. Goodwill, it's the amount by which the purchase price is higher than the fair market value of the net assets. Let's drink that in together. Goodwill is the amount you pay for a company minus the fair market value, not the value that that company has on its books. Remember, we bought that building on the ocean front here back in 1960 for $100,000. Now it's worth 10 million. On our financial statements, it's 100,000. But when somebody buys our company, they can put it on at the full 20 million. And let's look at an example here. And this can be a little tricky at first. Again, you do a few of these problems, get the hang of it. Goodwill is not amortized. Okay, that's a good thing to know. What amount of goodwill should be recorded here? Company paid $2 million, right? 2 million, that's the purchase price. And they assumed liabilities of 400,000. They appraised those assets to be 1,800,000. They might have only been $10,000 on the books of UTEC, but we value them at 1,800,000. So the fair market value was 1,800,000 minus the 400 tells us that we bought a company that's worth 1,400,000, but we had to pay 1,800,000. Take a look at this. 1,800,000 is what we say the assets are worth, and that's what we're going to debit on our balance sheet. When you buy a company, of course you assume their debts. You got to pay the bills. So we purchased a company worth 1,000,000 for $2 million. Do we make a good deal or a bad deal? What do you think, Dominic? You got any ideas on why a company would pay so much more? Why are we paying 2 million for a company that's really market value is only 1.4? Got any ideas on that?
Maybe they find the intrinsic value worth
you
the up price.
There you go. I love that word. Yeah, intrinsic. Yeah. Yeah. What's happening here is RPAC, I bet, has been looking at their competitor, maybe UTEC, and they've been saying, man, if we could take over that company, we can run it so much better. We can really increase its profitability. If we get a shot at their customers, yeah, exactly. So you might pay more or less, depending. And here's just a few examples of intangible assets. Trademark, the Visa card, huh? Trademark, recorded at cost. Copyrights, the exclusive right. You write a book, you got the copyright for the rest of your life plus 70 years, okay? So that one goes on a long time. And these do get amortized. Amortized. Here's the most common one we're going to talk about, a patent. A patent is your right to profit only by yourself due to a patent you own, okay? And there's a couple little rules we'll talk about now. What is a patent? Right now, pharmaceutical companies are scrambling to come up with a vaccine for the COVID-19. And they're spending millions and millions and millions of dollars in this endeavor. Let's assume Eli Lilly comes up with the vaccine and they prove that it works. And they file for a patent. They send us into Washington, D.C., and the federal government says, yes, we recognize your patent. Eli Lilly then becomes the only company that can sell the vaccine. They own the patent. Okay? But Eli Lilly cannot amortize it because the only company that can amortize the patent is the company who purchased it from another company. Research and development costs, all the millions and millions of dollars that Eli Lilly spent to develop this vaccine, have been expensed as research and development costs. They didn't capitalize any of it. They got the tax benefit of these expenses, reducing their net income. So they own the patent. What that means for Eli Lilly, they can decide that they and they alone will manufacture this vaccine, and they alone will market it and sell it. But maybe Eli Lilly doesn't want to do this. Maybe they want to cash in. So another pharmaceutical company like Merck steps in and they buy the patent. Now that company can amortize it. That company can amortize. And I know I'm going a little bit quickly now, and this is a matter for you to go back to your chapter and review some of these things. A few more examples of intangible assets, the franchises. You know, you open up a McDonald's restaurant, you've got the rights to that franchise's services. Purchase price, intangible asset, intellectual property, okay? Cash flows. Do we want to look at this? I don't think so in this chapter. And we're just about done with this chapter. I'm going to take you through this real quick. This is one supplement that I do think will be on the test. What if we change the life of the asset? Remember I was saying earlier that we might have an asset and maybe we put more money into that asset and extend its life. What do we do? If the estimates change, the book value less any residual at the date of change is depreciated. That's kind of a convoluted sentence. And what we're talking about is Southwest bought an aircraft for 60 million. They were depreciating it over 20 years. In year 5, they said, you know, these planes are going to last 25 years. What do? This is your template. This is your template. And this can be a little confusing at first, but let's take a peek at it. They bought this aircraft for 60 million. We're going to put 60 million here. And they had a certain amount of accumulated depreciation, which is this number times 4. That's the book value after 4 years. Now they're estimating that the life of this thing has changed. So let's look at the calculation. You bought this asset for 60 million. For 4 years, you have depreciated it. So you have a net book value of 48.6. But now you changed from 20 to 25 years. So instead of having 16 years left to depreciate, you have 21. This is a little tricky. Again, this little grid here, this template, if you will, is very useful. What it boils down to, guys, is you take the book value at the point where you're making the change, subtract the new residual value, and divide by the remaining years. We're done. You want to go into chapter 9 for a couple hours? No? I guess not, huh? Hey, Maria, did you watch the baseball game last night?
No.
Jesus, Dominic and I are, Dominic's a Dodger fan. He's happy. I'm a little nauseous, but boy, oh boy. What do you think, Nicole? You got any questions?
I don't think so.
Yeah, once again, it's a matter of going in and doing some of the problems, huh?
Yeah. Can you stay on there so I could screenshot it so I have it?
Yeah, and of course, these PowerPoints, of course, are available on Canvas. You've got them.
Thank you.
All the PowerPoints are there.
Okay.
So,
Picture.
Suda, tell us what you think here. You got any thoughts?
I guess I just have to go back and review all of your
Yeah.
PowerPoints.
Yeah, we
Just
threw a,
maybe
go ahead.
because it's going a little fast for me, but if I do it the second time, it might stick more a little.
Yeah, I hope so. I'm quite sure it will. We threw a lot at you today. 3 depreciation methods. We threw depletion, amortization, goodwill, disposals of fixed assets, changes. Maria, what do you think? Any questions?
Well, I'm a little bit confused still with the units of production method.
Sure, let's go back.
No, here is very clear how you explain it, but I was looking for some, I got some problems on the on the assignments. So in the assignment, I didn't find it. There was 30,000 something.
Okay.
You see, like here.
Units of production method, huh?
Yes.
Okay. You're good with straight line, right?
Yes, I understand that one.
Okay, so let's take a look here. The first thing we want to know, remember, is we have to subtract the residual value, right?
Mm-hmm.
So we're working with the same $60,000, right?
Yeah, I found that one, but do you see here? It says that use 30 miles in the first year. So
Yep.
I was looking how in here you said that they are gonna give you that amount.
Absolutely.
But in that problem, I just had to compute the units of production to use this, but they didn't give us the miles or the hours or something like
Is that
that.
something you can share? Screen share?
No, it's in
Okay.
the assignment.
Yeah. I'd have to look at it. Okay. They have to give you the miles. I would, read the question again. Maybe you're mixing up the estimate with the actual. I don't know. You could send it to me a little bit later, but you do understand how to do the computation.
Yes.
60,000 over 100,000 means 60 cents a mile.
Mhm.
We're gonna multiply these guys by 60 cents here. Okay. So you're saying they're giving you, so you're saying they're not giving you this, huh?
No, I didn't find those.
Why
Does
don't
it
we
work?
do this, Maria? Is that something you could, maybe copy and email to me so I can look at it? Okay,
And that's why I was very confused. I said, I was
Yeah.
looking to the book and I didn't find,
okay.
yeah.
All right. Yeah, send it to me. Okay.
Okay.
All right. Anybody have any more questions? I guess
Good.
not.
Thank you, Bob.
Hey, you take it easy, everybody, okay?
Thank you.
Off we go. Bye-bye.
Yeah.
Thank you. Bye.
The friendly wave. Bye-bye. How do I end this thing? Jesus. Oh, here it is.